Alright, listen carefully because what I'm about to show you might completely change the way you look at trading. Forever. Alright, now let's lock in because this is where things start to click. So first, what exactly is a moving average? By definition, a moving average is an indicator that you place directly on your chart, and what it does is it smooths out price. It filters out all the noise, all the random spikes, all the messy fluctuations, so you can actually see the real movement behind the market. Think about it like this. Price is usually chaotic, jumping up and down, faking you out. But the moving average, it cleans that up and shows you the true direction underneath. Now listen. Don't overthink that part, seriously, because the way we're about to use the moving average in this strategy is way more important than the textbook definition. And here's something you need to understand. Every professional trader out there, they know exactly how to use this indicator properly, not casually, not randomly, but with precision. So here's what we're using in this strategy, a very specific type of moving average called the exponential moving average with a length of 50. That means EMA 50. So right now, I want you to actually do this with me. Open your charting platform, whatever you're using, go to your indicators, search for exponential moving average, add it to your chart, and set the length to 50. Done. Now your chart should have that smooth line running through price. And Mrs. Reppings gets serious. Because this next part, this is critical. You have to understand this if you don't want to trade like a beginner. Professional traders, listen carefully, they never use the moving average alone. Never. They don't rely on it by itself for analysis. They don't blindly enter trade just because price touches it. They don't treat it like some magical signal generator. Instead, they use the moving average for one thing and one thing only, confirmation. It's there to support what they've already identified when analyzing price movement, not to replace their analysis, but to strengthen it. And once you truly understand that difference, that's when everything starts to shift. Now this right here is where everything starts to make most sense. So the question is, why are we even using the moving average in the first place? Let's break it down. Fast, clear, and powerful. Reason number one, the moving average acts like confirmation of what kind of market you're actually in. Bullish, bearish, or just going nowhere. Now watch this, because this is where most beginners get it wrong. When the EMA 50 is sloping downward and sitting above price, that's telling you something very important. That market, most likely bearish in a downtrend. Price is being pushed down and the EMA is acting like a ceiling. Now flip it. When the EMA 50 is sloping upward and sitting below price, that's a completely different story. Now you're looking at a bullish market, a clean uptrend where price is being supported from below. And now this one is critical. When the EMA 50 goes flat and price is just bouncing above and below it, no direction, no momentum. That's a sideways market. Consolidation, choppy, messy, unpredictable. And just by looking at that one line, you already understand the condition of the entire market. Reason number two, this is where it gets really interesting. The moving average can signal a potential trend change. Watch this carefully. Imagine price is clearly in a downtrend, lower highs, lower lows, everything pushing down. Then suddenly price pushes up and breaks above the moving average line. That moment, that's your signal that something is shifting. A potential transition from bearish to bullish. Now the exact same thing happens in reverse. If price is in a strong uptrend, then starts dropping and breaks below the moving average, that's your warning sign. The trend could be flipping from bullish to bearish. Same logic, different direction. Reason number three, and this one is where traders start getting real entries. The moving average can act as dynamic support and resistance. Let me show you exactly what I mean. If price is in a bullish trend, moving up cleanly, and you see candlesticks forming above the EMA 50, that tells you price is respecting that line, it's recting to it. But EMA 50 is acting like support. And when price pulls back, comes down, touches that EMA, and then bounces, that reaction right there can signal a continuation of the bullish move. Now, look at the opposite scenario. On this chart, price is moving the other way. We're in a bearish trend. Price is moving below the EMA 50, which means that line is now acting as resistance. So when price pushes up, taps into the EMA and then gets rejected, drops back down, that reaction is telling you there's a strong chance the market will continue moving bearish. So after all of this, here's the most important thing you need to understand. This is everything. We are not using the moving average as some kind of rule book. It's not law. It's not a signal generator you blindly follow. We use it as a lens, a way to read the market more clearly, because again, we do not use the moving average by itself to enter trades. We combine it with price action and market structure to stack confluence and dramatically increase our trading accuracy. All right, now we're stepping into the part that actually makes you money. Pay close attention, because this is where everything we talked about starts getting applied in real trading. So now let's talk about how to actually use the EMA FE 50 inside your trading. We're not just talking theory anymore. We're putting this directly onto the chart and using it to execute. So here's what we're doing. We're adding the EMA 50 to our chart, and now we're going to apply everything we just broke down. And in this strategy, there are only two ways we use the EMA 50. Only two. No confusion, no overload, just precision. One, trading with the trend. Two, trading reversals. That's it. Let's start with the first one, trading the trend. And I'm telling you right now, this is one of the most accurate trend trading approaches you will ever see. Not pretty good, not sometimes works. I mean, high probability, consistent, repeatable. If you actually follow every step, you cannot skip anything here. Every detail matters, because when you execute this properly, you start getting entries that feel like they're almost unfairly accurate. So let's break it down step by step. Right here, we're starting on the daily time frame. First thing you do, you identify the trend. And in this case, it's crystal clear. Price is making higher highs and higher lows. That means only one thing. This is an uptrend. So what's your job? Simple. You trade with the trend, not against it. Next step, now that you know it's an uptrend, you need to identify your support area. Look at the chart, see those points where price drops, then reverses back up. Those reactions, that's your support zone forming. But here's where it gets powerful. What makes this level even stronger is that the EMA 50 is sitting right in that same area. This is what we call confluence. Two factors, same zone, stacking together, and that changes everything. Because now, if price comes back down into this area and shows signs of bouncing, that bounce is not random anymore. That is a high probability reaction. And if you take a buy entry from there, you're not just guessing, you're positioning yourself for a move where the reward is huge and the risk stays tight. That's the game. And trust me, you do not want to miss what I'm about to show you next. Because this next step is how you start spotting those high probability bounces early. Now watch this. As price starts moving down, getting closer to that support EMA 50 zone, you don't just jump in. No, you wait and you ask one question. Is price going to react here? Is it going to bounce or not? Because what you're looking for is price action that shows rejection and a move back up. But before you make any decision, you zoom in, you drop to a lower time frame. This is critical. You go to either the 1 hour chart or the 4 hour chart. And in this strategy, I personally prefer the 1 hour time frame. Why? Because it gives you more detail, more clarity. You can actually see what the market is doing step by step. Now, before we go deeper, you need to understand something very important. Why are we even analysing the bounce in the first place? Why not just enter immediately? Because the market doesn't always react the same way, and there are 3 possible scenarios when price reaches this confluence area. Scenario number 1, price comes into the zone and then just moves sideways. No direction, no clear movement, it's just consolidating. That means the market is either confused or preparing for a bigger move. And that move could be up or down, you don't know yet. Scenario number 2. Price doesn't hold, it keeps dropping, breaks below the support, breaks below the EMA 50, and continues down. Now that's a warning, because that could mean the trend is shifting from bullish to bearish. And to confirm that shift, you'll need deeper market structure analysis. Scenario number 3. This is the one we're waiting for. Price comes into the zone and then boom, it bounces. Strong move back up. This is your signal, because in this context, that bounce has a high probability of continuing higher, since the market is trying to continue the existing bullish trend. So Out of these three scenarios,